Hello everyone, welcome to the 185th episode of me learning how to trade in Forex. So in the last episode we went through simple strategy 1, trading the delta. So we aren't limited to trading a single option at a time. So this means the options opens up the possibility of many types of trading strategy using a combination of calls and puts options. So these are known as spreads, and they involve both buying and selling options simultaneously. So spreads can help you make money even when the market is static. And one of the most popular trading or spreading strategies is trading the delta or delta spread. So delta, the Greek, what do you call it? The Greek. Oh, that's called the Greeks. So yeah, the delta Greek is a ratio that tells you how much an option's price moves for every movement in the underlying asset. So it measures how the movement in the underlying market will impact the price of the option. Delta spread is basically can be profitable when markets are showing little or no volatility and you don't expect the price of an asset to change. So you may be able to set up a delta spread to make a small profit if the underlying asset does not change widely in price. However, larger gains or significant losses are possible if the asset does the unexpected and moves significantly in either direction. So for delta spread, you establish a delta neutral position by simultaneously buying and selling options in proportion to the neutral ratio. So in other words, the positive and negative deltas offset each other so that the overall delta of the asset in question equals 0. So the most common delta spread is a calendar spread, so this involves constructing a delta neutral position using options of different expiry dates. So you simultaneously sell near month call options and buy call options with a later expiry date in proportion to their neutral ratio. So since the position is delta neutral, there will be no significant gains or losses from small price moves in the underlying security. However, as a near month call loses time value and expire, you should be able to sell the call options with longer expiry dates to gain overall profits. I went through an example of that and what is a risk. So the delta spread, the maximum loss is approximately limited to the premium paid, but can increase if the underlying asset has a large move and the delta of the options changes. So should you be trading delta, ask yourself, is the asset price static? Does it look like as though it could remain so for the period you want to speculate on? If answer is yes, maybe time to look at delta strategy. And then work through the lesson summary. And then we started going through the simple strategy 2, so straddle and strangle. So both straddles and strangles use a combination of calls and put options. So while delta spread lets you take advantage of static markets, buying a straddle or a straggle allows you to maximize your profit when the market is volatile. So the more volatile it is and the more the market moves in one direction, the greater your profits can be when using the straddle or a strangle. So how to use a straddle? Straddle involves simultaneously buying both a put and a call option on the same market with the same strike price and expiry. By doing this, you can profit from volatility, so regardless of whether the underlying asset moves up or down. But there is a risk of, if no volatility occurs, you'll lose your premium. So straddle purchases puts and calls options with the same strike price and time periods. So it gives you an example here, and it would look like. And then shorting a straddle, so with a short straddle you can benefit if the volatility collapses, so by selling both the calls and the puts options. So strategy behind a short straddle is reaching the break-even point where the underlying asset is entirely either at the money, the strike price, or out of the money. This will be below the strike price for a call option, but above the strike price for a put option. Either case, the option contract would expire worthless, and the gain for you will be the profit you collect from the option premium. So the risks in a short straddle strategy is unlimited, as the underlying asset price could move either up or down, well beyond the strike price of either option. Should you be using a straddle, ask yourself the following: is the market static? Does it look as though it could remain so? If the answer is no, might be time to look at using a long straddle. Do you believe that volatility will collapse? If yes, it might be time to consider a short straddle. Then we've got the strangle. So strangle, similar strategy, but here you buy a call with a slightly higher strike price than the put. So that means you need a larger price move to profit, but you typically pay less to open the trade because both options are purchased when out of the money. So strangle's key difference from a straddle is therefore in providing greater flexibility of balancing the cost of opening a strangle versus a probability of profit. So given the same underlying security, strangle positions can be constructed with low cost and low probability of profit, or higher cost and a higher possibility of profit. So strangle purchases involves puts and calls that are separated by at least one strike price in the same time period. Okay, so it involves buying a call option for strike price that is slightly out of the money plus a put option for strike price that is slightly out of the money. And then we went through the long and short. So straddles can either be long and short. Strangles, not straddles. Strangles can either be long and short. Long strangle, you buy the calls and puts. This strategy is to profit if the underlying asset makes a move in either direction, and use a long strangle if you're expecting the underlying asset to make significant price moves, such as in advance of an earnings announcement. So potential profit is virtually unlimited, and your risk is limited to the option you pay. So through an example, even though you have to let the put option expire worthless, you still have to count the cost of your option premium when calculating your profits. That's where we left off at in the last episode. So I think in the last episode I left it off at here because I can get my head around what this example was trying to tell me. So let me just go through it again and see if I can understand it now. So long strangle, buy the calls and puts. Strategy is to profit if the underlying asset makes a move in either direction. Use a long strangle expecting the underlying security to make significant price moves, such as in advance of an earnings announcement. Potential reward is virtually unlimited, and your risk is limited to the option price you pay. So for example, you see the FTSE 100 has been in the tight range for a few weeks. I believe it's due to break out of this pattern. Index is currently trading 6,500. You think that there will be a larger move over the next few months, so decide to buy a 3-month 6,700 call price at 25 and a 3-month 6,300 put priced at 30. You buy one contract of each. Total cost for this is 250 plus 350, which is 250 plus 300, which is 550. So this is your maximum risk, so your option premium. 3 months time, the FTSE, so buy 3 month and 3 months, so both are 3 months. In 3 months time, FTSE has surged after positive economic data, reaching 6,800. This point, the 6,300 put is worthless, but the 6,700 call is worth 100. So call is you can buy it back at a lower price. You can buy it at a lower price than the market price. Therefore realize a profit of 450 on this strategy. 450. This is equal to the profit made on the 6,700 call minus a loss on the put. So loss is just the premium, which is 30. Profit equals price of the other line minus the strike price minus net premium paid. Oh, it should be 450. Yeah. Because no, shouldn't it be 450 minus the minus 30? Because 250 times by 10, that's 250. 100 minus 250. Wait, 100 minus 250. Hey, 100 minus 250. How does that work? That gets you negatives, 100 minus 250. Yeah, that will get you to negatives. So, how I would have thought is total cost is 550. So call is worth 100 points. Oh, 250. So you lose the premium of 30 points. So 30, 0, 100. That's just 30. So you lost 30 points worth of premium. You lost 30 points of premium. Yeah, I'm not going to be able to figure this out. So time to skip. Yeah, so what about the risk versus the rewards? With a long strangle strategy, the maximum profit is unlimited because theoretically there's no limit to how high the underlying asset's value can rise. On the put side, the underlying price can only go to zero, capping your profit if it does so. However, your risk is limited to the option premium. Should you be using strangle? So is the time right for a strangle? Ask yourself, is the market volatile? Does it look as though it could experience some major move? Ask yourself, is the market volatile? Does it look as though it could experience some major moves? If the answer is yes, can try long strangle. If the answer is no, mark to consider short strangle. Can try short strangle. In a short strangle, you are selling the calls and puts. So in short strangle, you're selling the calls and puts options. You are predicting the underlying price will show little volatility, remaining somewhere between both strikes you selected so that the options you sell expire worthless. So you're hoping the asset price isn't going to go up, so you can just make the premium off of whatever options contract you got. So you're hoping the underlying asset price will show little volatility so that the options to remain somewhere between the two strike prices, so that the options you sell will expire worthless. The risk potential is limited due to the net credit you earn from the premium you collect, but the risk is virtually unlimited because in a worst case scenario you would be responsible for the options. The maximum profit is limited to the premium. The risk is theoretically unlimited. So back to the FTSE 100. Let's say a period of geopolitical uncertainty has been resolved, and with the UK in calmer waters, you feel that the index could be ready for a pause in volatility and will trade in the tight range for the unforeseeable future. The price of the FTSE 100 is currently at 6,500. You sell a 3-month call option with a strike price of 6,800 at a price of 10, plus you sell a put option also expiring in 3 months' time with a strike price of 6,100 at 15. You sell one contract £10 lot size per point, so you would stand to make a maximum profit of £250. So that's 10 times 10 plus 15 times 10, so 100 plus 150, that's £250. How does this play out? If the FTSE finishes between 6525 and 6075 in 3 months' time, you'll keep the 250 premium. For every point that the FTSE finishes above 6825 or below 6075 expiry, you lose £10 per point, since you sold one contract with £10 lot size and the call and the put. What about the risk? As a seller of the option, your maximum risk is virtually unlimited. So homework, which markets are volatile right now? How might you use a straddle or a strangle to profit from that volatility? Test out your idea in a risk-free demo account. Log in now and give it a try. Lesson summary then. Straddles and strangles provide a way of trading when assets are volatile. Buying a straddle and strangle allows you to maximize your profit when the market is volatile. The more volatile it is, the greater profits can be. Straddles involve simultaneously buying both a put and a call option on the same market with the same strike price and expiry date. Strangle purchases puts and calls options that are separated by at least one strike price in the same time period. And the strangle offers more choices and can be set up lower cost, low potential profit, or higher cost, higher potential profit. So quiz. When you buy the call option, it gives you the right to buy an asset at a set price on or before a set date. The right to buy an asset. What is the strike price? Price of the underlying asset, the price at which the option holder can buy or sell the underlying asset. Yep. If in a rising market, you can make money by buying assets below the market with a call option, because then you can buy it below the market price and then sell it, to make a profit. Which key factors affect option prices? Underlying price, volatility, time to expiry. If the volatility of a security is higher, the option price will be higher. When buying an option, either call or put, your maximum risk when buying an option equals the premium paid. When selling option, your maximum risk is theoretically unlimited. Buying a call option with a strike price of 6,500 and a premium of 100 will result in a profit if buying a call option and a premium if it goes above 6,601. Because you're taking into account the premium. No wait, buying a call option, so you're hoping it will rise. Yeah. Selling a put option with a strike price of 6,500 and premium 35 will result in a profit if a put option. So you're hoping put option hopes the underlying asset goes down, so you're selling it. So you're selling a put option. So you don't actually hope it's going to go down, because when you sell it, when you're selling it, you hope the buyer doesn't really exercise the option, so you can claim the premium they paid for yourself. So you don't really hope that the option is going to go down. You want it to go up instead. So premium 35, so 6,500 plus 35, 6,530. Selling a put option, strike price, so it's got to go above 6,535, right? But none of them are 6,535. Premium. No, what's 6,500 minus 35? 6,465. So 6,465. If it goes above 6,465, so that one, 6,513. Suppose you buy a strangle on an index currently trading at 6,500. Buying a 6,700 call priced at 25 and a 6,300 put priced at 30. £10 per point, one contract. You make a total profit on the strategy of if the index reaches. So you're trying to strangle 6,500, buying a 6,700 call priced at 25, 6,700 call, 6,300 put priced at 30, put priced at 30, £10 per point, one contract. So £500 if the index reaches 6,600, 500 if the index 6,700. Buying a 6,700 call priced at 225. So strangle. This is where you hope that there's going to be some sort of volatility after a period of calmness, isn't it? Strangling. So profits in the underlying asset moves in either direction. So also you're hoping it to move from static. Right, okay, so you're hoping it to move from static. So it's currently trading at 6,500. So you're hoping it's going to move from that. Buying a 6,700 call option. So you profit from that if it went above 6,726, right? And you also make a profit if it went below 6,270. So 25 times by 10, £250, 30 times by 10, 250 plus 300, 250 plus 300, that's 550, so 550 is not even on there. 25 times by 10, 250 plus 300, 550, eh? 550 minus, because you got to put minus the premium, right? So minus a premium of, I'm assuming this one's not going to trigger, 6,300, so minus 30, 550 minus 30, 520, that is still not right. If the index reaches 6,700 on expiry. So if it reaches 6,600 on expiry, you wouldn't exercise the call contract, call option, because you can buy it higher than 6,600. 6,300 put. So you're trying to sell it 6,300 put. But that's only if it's below it. No way, it needs to be above it, so you can sell it for more than what the market is paying. I'm so confused on this one. Let's see, what's the notes? Strangle buying a slightly higher strike price than put option. Buying a call option, slightly higher strike price than the put option. Strangle, one strike price. Makes a move in either direction. Either direction. I'm going to choose a random one because I really don't know, to be honest. That one. Oof, 80. So, when you buy a call option, it gives you, buying a call option gives you the right to buy an asset at a set price on or before a set date, whilst buying a put option gives you the right to sell an asset at a set price on or before a set date. Remember, in both cases, you have no obligation to buy or sell if you won't profit by doing so. Price at which an option holder can buy or sell the underlying assets. The option holder can buy or sell the underlying asset at the strike price, sometimes known as the exercise price. For call options, the higher the strike price, the cheaper the option. For put options, the higher the strike price, the more expensive the option. Sometimes known as the exercise price. The cheaper the option. For call options, the higher the strike price, the cheaper the option, because you're hoping for the, oh my god, I keep forgetting why. So yeah, call option is right. So for call options, the higher the strike price, the cheaper the option, because the less likely is probably going to reach that strike price. For a put option, the higher the strike price, the more expensive the option. Put option believe the asset price will fall. The higher the strike price, the more expensive the option. Why is it more expensive? Okay. I thought, yeah, I don't know, to be honest. I thought call option, the higher the strike price, the cheaper the option, because I thought, because you're hoping the thing's going to rise, so the higher the strike price, the less likely is going to reach that point, right? But for a put option, you're hoping the asset price is going to go down. So why is it more expensive if you priced it higher? So buying an asset below the market with a call option means being able to acquire it for less than its market value. Where a put option will work in a falling market because it gives you the right to sell the asset for more than its market value. Yeah, so buying an asset below the market with a call option means being able to acquire it for less than its value. Put option will work in a falling market because it gives you the right to sell the asset for more than its market value. Oh, I see why. Because for put options, the higher the strike price, the higher you can sell the asset at if you do exercise the option. So this is the, let's say, the black line or the pink line, whatever. Which one is this? Yeah, the red one is the current market price, right? So that's the current market price. If we're doing a put option, so let's say our strike price is here. Oh no, wait. I think higher, when they say higher, it meant not literally above the underlying market price. Like, the closer it is to here, the more expensive it is because the more likely it is for the underlying market price to reach that point. For call options, the higher the market price, so the higher the strike price so the higher that price, the cheaper it is because the higher you go, the more further it is away from the underlying asset price, the less likely it is to reach that. Gotcha. So, in a rising market, you can make money. So, buying an asset below the market with a call option means being able to acquire it for less than its market value. Put option will work in the falling market because it gives you the right to sell the asset for more than its market value. Yep. So what key factors affect option prices? The strike price also affects as well. Okay. The underlying price provides a baseline, whilst the distance to the strike price, of course, yes. The market's volatility and the time left to expiry all determine the probability that the strike will be breached. This equates to the level of risk for the option writer and so affects the price they charge for the premium. Your margin is based on the option price but doesn't affect it. So if volatility of a security is higher, the option price will be higher. If the volatility of a security is high, there is a greater risk for an options writer. They will demand higher premiums to compensate for the extra risk of loss they may face. Conversely, low volatility means lower premiums. So when you buy a call or put option, you have no obligation to follow through on the trade if your assumptions were incorrect. Your losses are limited to whatever you paid for the contract and trading fees, so your maximum risk is equal to the premium paid, which is simply calculated by trade size multiplied by price. So when selling a call option, your maximum risk is theoretically unlimited. So when you sell a put or a call option, you are obliged to buy or sell at a specified price within the contract's time frame, even if the price is unfavorable to you. When you sell or put, if the price of the underlying asset should fall to zero, your losses will be limited to the whole of the strike price of your option. But when you sell a call, if the price of the asset rallies, there's no cap on how it can rise, so there will be no limit on your losses. So in this example, you have the right to buy an asset at a strike price of 6,500. Anything below that results in a loss. You lose the premium you paid, but if it reaches 6,500, you are no better off. There's no point paying for the right to buy it at the market price. If it reaches 6,550, you can exercise the option to make some of the premium back, but it's not until the asset reaches 6,600 and above that you cover your premium and start getting into real profits. Yep. So when you sell an option, you receive the premium. You need the option not to be exercised to avoid the obligation it will give you. In this example, if the underlying expires at 6513, there will be no danger of the option being exercised and you keep the full premium. Right, okay, so this one. Suppose you buy a strangle on an index currently trading at 6,500. buying a 6,700 call priced at 25 and a 6,300 put priced at 30. At £10 per point, one contract, you make a total profit on the strategy of 450 if the index reaches 6,800 on expiry. In this example, you would make a total profit of £450 if the index reaches 6,800 on expiry. At this point, the 6,700 call is worth 100. However, you need to cover the cost of the 6,300 put, which expires worthless. So the overall profit of 450 is equal to the profit made on the 6,700 call, which is 100 minus 25 times 10, which is 100 minus 250. That's the negative number again. That's why I didn't get it. Less the loss on the 6,300 puts. 30 minus 0, that's 30, and the total premium paid of 550. Total premium paid of 550. Right. Yeah, no, I don't understand. Still can't get my head around this, so gonna skip it for now and mark this. That's my mark thing. Need more understanding. Sad face. Alright, so let's see. Where are we? I think we're just done trading with CFDs. So simple strategy 1 and 2. Not really that simple. So now we're on to trading listed options, which is the last course I think of this advanced IG. So trading listed options. This course provides a thorough introduction to the principles of options contracts and how they're traded. It begins with the basics before delving into factors that influence an option's value as well as the probability of returns. Finally, we'll introduce you to some key options trading strategies. Great food for thought as you embark on your options trading journey. Cool. So, well, it's a bunch of videos. This is so. What are options? Well, shouldn't this have gone before the other one? The other lesson that we've done. So, just go through this briefly. An option is a standardized financial derivative contract that gives the owner the rights but not the obligation to buy or sell 100 shares of the underlying asset at a specific price, referred to as the strike price, any time up to the given expiry date. There are two basic types of options: call options, the right to buy, and put options, the right to sell. Simplest option strategies are to buy a call if you think the underlying share price will rise, or buy a put if you think the price will fall. More complex option strategies combine the buying and selling of calls and puts to maximize the probability of returns in certain market conditions. The market price of an option, also known as a premium, reflects both the intrinsic and the extrinsic value of the contract. Options' intrinsic value is simply the difference between the strike price and the underlying share price. Options have intrinsic value when they are in the money. For example, call options have intrinsic value if the strike price is below the underlying share price, whilst put options have intrinsic value if the strike price is above the underlying share price. Options are out the money or at the money have zero intrinsic value. Extrinsic value is driven by other factors affecting the probability that the option will expire in the money, specifically how volatile the underlying market is and how much time there is until the contract expires. This means that out the money options with zero intrinsic value might still have extrinsic value. For example, there's enough time for the underlying price to shift in the options holder's favour before it expires. Learn more by watching these guides on the basics of options, which I'm going to do in the next video. In the next video then, I'm going to make some notes on this, and then we're going to watch through the videos and then carry on from there. Thank you all for watching, and I shall see you guys in the next video. Laters.